Welcome to SF Commercial Property Conversations with Bruce Bean, where Bay Area investments meet expert insights. Get ready to unlock the strategies of commercial real estate success.
Okay, so today we have Heath Binder with us, and Heath is with LBX Investors, and he is the investor relations person, but he has taken a interesting journey from Philadelphia to Ohio to Liverpool. Anyway, Heath, it's great to have you. I will let you explain a little history of how you got into real estate and how you got to LBX.
Oh God, how I got into it. Thanks for having me, Bruce. Yeah, no, I got into real estate. Oh God, it was what, 2002. Short answer is 9/11 happened, and I was sitting in New York, and I was working for an architectural publishing startup at the time, and
Oh, wow.
then I thought, okay, well, I mean, really, what I thought was, wow. I mean, I was just a little kid, like I was thinking, well, why would, why would somebody want to bomb, not bomb, like why would somebody want to fly planes into the towers?
Yeah.
And so I started reading The Economist, and I realized that I just didn't know what I was reading. I didn't know the terms. I didn't know anything, and I didn't like that. So, I have family members who are in commercial real estate.
Oh, okay.
And I started talking with them a little bit, and they all told me I should go and try to be a broker. That was the good starting point for it. So I started looking for, the world was a much different place at the time, but I started looking for ads. So I opened up a New York Times ad. Colliers in New York City was looking for a rookie broker. I thought, okay, great. That's what I want to do. So I called. I actually called a New York Times ad. I, I landed an interview, and I've always been pretty good on the phone. So I was able to get in. They were very willing to basically pay me nothing and have me bang on the phones for them. So I went and I took that job, and I was in the industry, and so the first thing they did is they gave me um, at the time in Manhattan, I'm sure it's not around anymore, but there was a big blue book. It's called,
Oh, yeah.
that's what it was called,
Okay.
the big blue book. And they just basically said, call all these people and try to find listings. So that's what I was doing. I was making probably like 10,000 calls a day. I don't know what it was, but I did that for a little while. And then um, Colliers wanted to up their institutional, their investment sales team. So they brought a guy on from Cushman. The guy took one look at me and was like, "You should go into leasing. You don't know anything." I said, "I know I don't know anything. Teach me. I want to learn." And he said, "Well, okay, fine, you can do that, but just keep in mind, you don't know anything." And he was right. I didn't know anything. So I started. NYU had or still has a pretty good real estate master's degree, and so I applied to that program part-time. I was at Colliers for a couple of years, and I sort of like leveraged my way using my background, learning from the Colliers guys. um, Leveraged my background into school, and then was able to use that to land myself more substantive type role with an appraisal slash consulting firm. So I did that for a couple of years, and then I got into. Then a teacher of mine told me that UBS was actually hiring junior equity research folks. And I thought, okay, well, let's go to Wall Street. Here I am. I'm in New York. That's a way to really learn the numbers, because I still didn't feel like I was getting enough, practical application of that. So I went, I interviewed, I got a job offer, and it was funny. I showed up at UBS, and I'd interviewed with three people the day I showed up. I found out two of them had just quit, and then my direct manager, he quit soon after, and
Whoa.
it was kind of a mess, but I was there for a couple of years, and that was really good formative training for me. And ultimately, I mean, that was what, 2005. So then you hit 2007, 8. You're into great financial you're in a GFC territory. Took a different job. That one didn't materialize. And then all of a sudden there I was in New York with some, good starting real estate experience, but, we were in a real estate led downturn. So, the way that you flash forward, the way that I'm doing what I do now is, moved to LA, met my girlfriend, now wife, moved to LA, did some different things, worked in wealth management, built some relationships, so on and so forth. And then I met the founder of Realty Mogul. This is the nascent days of crowdfunding. And I, took a job there, basically just speaking with investors. And that was how I, started to, really find my groove. And that's what I've been doing for the last 12 years or so. Just, basically speaking to investors about real estate deals. After a few years after a couple of years of Realty Mogul, I moved to the predecessor group to what is now LBX. And, now what I do now is basically, I don't want to say it's the culmination of, but it's basically, it takes all of my previous experiences and it wraps it all into one package. So, I've got a lot of experience, on the data and analytics side. I was a research analyst for a couple of years. So, there's also a financial journalism aspect to that. And then, I've always been pretty heavily skewed towards relationships. And so what I do now is a combination of really two things. One is I raise money for the deals that we do, which are predominantly open air shopping centers, but we also invest in multifamily. So LBX Investments is active in both sectors. So I raise money for deals, and that's with small investors all the way on up to large institutional capital partners. And then I oversee all investor relations functions. So, and it's a big differentiator for us, I think. I actually write the quarterly reports at many comparable companies. I mean, I don't think there's anybody out there like LBX, of course, but at other other real estate companies, quite often they run the reporting through asset management. Here it runs through me. I write the reports each quarter. I oversee all communications, so marketing presentations or analytics around specific properties or around our industry. I'm overseeing all of that. So it's been good for me. I've got a lot of control and ability to shape the messaging that we're communicating to the market.
Well, let's get into that. What differentiates LBX from all the other potential real estate investment groups out there?
I mean, I'm sure a lot of great real estate companies. I mean, I know some of them, but I mean, I think some of our differentiators are, first off, we're, extremely investor centric, very, very transparent with, with our community of investment partners. So, I think our reporting is very, very detailed, and our investment memos up front. If you're gonna put money with us, I don't care if it's $50,000 or $1 million or something much larger. Our general view is that if you're going to put money with us, you should have a really good idea of how we're thinking about the investment, what the risks are, what our strategic initiatives are, what the support for that is. And then during the life of the deal, you should always know how your money is doing. So, our transparency and reporting and communications are I think really strong. And then in terms of how the company operates, I'd say a couple areas. One is we are very, very hands-on active operators. One of the big differentiators for LBX is we've got a very, very highly developed infrastructure. Retail is in particular is not an easy business to break into, right? I mean, I think multi is easier, right? If you think about it, there's just a lot more multi operators out there, and you can go and buy multi. And I mean, I know a lot of guys who have less experience who've gone and build a multi portfolio. But retail, you really need the relationships and the infrastructure, and it's not just something that you just have. It takes years to build it. So I think, our approach and the infrastructure that we bring to the table, the relationships we bring to the table, I think are, really, really powerful differentiators for us. And, we performed really, really well, but I think increasingly today, compared to a couple years ago when money was cheap and
Mm.
people were thinking less about this, I think, for investors, it's really, really important to, choose the jockey, right? And make sure that they're, really comfortable with, who they're putting their money with, and they have a really good understanding of how, um, how that company, adds value to deals, right? And those are areas that, we do really well, right? So that's what I would point to.
So I'm curious. So during the post-pandemic, obviously interest rates were very low. You could potentially buy things for whatever interest rate you could get at the time. So are you in a position now where you have to kind of turn over some of those loans? What's happening with that situation?
Um, no, I mean, so when we, most of our portfolio is retail
Hmm.
currently. We've one pure play multi-asset, and then we have another mixed use asset, which is, it's a large property that we bought in Washington, D.C., which is multi and retail. And everything else is open air shopping centers. And open air tends to trade at wider cap rates,
Mm.
right? Than what you would see in multi. And kind of going back to, I mean, LBX, um, the two managing partners, they have very, very deep multifamily experience. And when they were, assessing the landscape, um, a decade ago, they saw much more what they felt were much more interesting opportunities in retail, because we're a little contrarian, we're value investors, and when you're buying multi, I mean, at the time it wasn't three caps, but when you're buying multi at compressed cap rates and you're up against 50 other bidders, to an extent, what you're doing is you're making a little bit of a bet on interest rates, and that's not as a firm, that's not really our DNA. We're not interest rate experts, so we don't want to be in a situation where we're taking risks that we're not comfortable with. So we've always used fixed rate debt. And so when you look at our portfolio, you're buying at, kind of wider cap rates, they're value add deals, so you're improving your yield on cost, right? And there's generally pretty healthy spread between our cost of financing and where we're stabilizing deals. And it's also generally bank financing. So, we have across our portfolio really, really good flexibility embedded in our loans. And, we haven't run into that issue really at all like what you've seen in multi where, you bought something tight and then things went against you and now you got to refinance and you're underwater. That hasn't been our story at all.
No, that's fantastic. So I'm curious, you're how do you even find deals these days? How far and wide are you looking? All over the US, it sounds like.
Yeah, yeah. We own we don't own in all 50 states, but we own nationally. We just bought a deal in San Diego. We own in Florida. We own in New Hampshire. We own in a few assets in Chicagoland.
Mm.
In retail, a lot of the deals are marketed. Um, if you're going to look, so everything we do is individual deals. We don't have a fund
Mhm.
uh, vehicle at this time, which I think is good because the deals aren't homogenous. We've sort of developed a knack for is finding deals that have a little bit of a almost like a special situation. Not that the deals are distressed, they're not, but we love to find deals where either you have a partnership that is triggering a sale, or you have a seller that's being forced to liquidate for some reason, um, or you have some other dynamic that is being misunderstood by the market. So case in point, we bought a deal. It's a great piece of real estate in Deptford, New Jersey, which is right outside of Philadelphia. Bought it a couple years ago. Bought it, pretty inexpensively, and there were a couple drivers for that. One is you had a fund, or you had a partnership that really was being forced to bring it to market because the the capital wanted out. The operator, I think, wanted to stay in, but the capital wanted out, so they triggered a sale. And also, that center has a Burlington, and Burlington, I don't know if you follow them or not, but back in 20 years ago, maybe even 10 years ago, Burlington had much larger footprints,
Oh yeah, they were
right?
hot.
And now when Burlington's opening new stores, they're more like, versus like 60, 70, 80,000 for the older Burlingtons, now they're like 30,000 square feet, right? And so if the market sees it, kind of going back to what we were talking about before the call, right? Like everybody wants a grocer, right? Everybody wants a grocery anchored center at like everybody wants a deal, right?
Right, right,
Everybody wants all the good stuff. So when the market sees a Burlington with a 60,000 square foot footprint, the market gets scared, right?
right,
Because
right.
they're worried that Burlington's going to leave, and so we looked at that center, and we do very, very extensive due diligence, and we got very comfortable. Um, After talking to the tenants, and doing like we do a very, very comprehensive due diligence process,
Right.
but we got comfortable with the idea that Burlington wanted to be at the center, to the extent that even if you went into the store, it was, they were already operating this is a few years ago, they were operating out of their contemporary footprint, not the old
Oh,
one.
right. Yeah.
So, we underwrote that they would stay, but that we would pay them, significant dollars in order to downsize their space. And, that's how we looked at the underwriting on that one. And that's how it's played out, right? Where, now they're downsizing and, but staying. And now we have this space next to them that, we'll be able to release at accretive numbers. And, that deal, is looking like it's going to end up being a really, really nice win for folks. But, it all comes about because, one is we looked at it a little bit differently. Two is we're able to buy it at a attractive price point, in part because he had a forced seller, and we're very happy to have that one in our portfolio. And so if you look across our portfolio, there are always, not for every single deal, but like for most of them, there's a story where we see value where maybe the market's missing it, or not sure how to assess it.
So that, so I'm curious, are brokers bringing you these?
Yeah, typically.
Yeah. Okay. Typically, you're not out there scouring, looking for particular properties per se.
We most of, particularly in retail, most of what you see is generated by the brokers.
Yeah. Yeah.
Now, it doesn't mean it doesn't mean that it goes through a perfect process. Not brokers are not all perfect,
Yeah. No.
right?
Right.
But yeah, I mean, basically, retail's a little different in that you're gonna, whereas in the heyday of multi, you might have 50 or I don't know, 67, like tens, and it was
Just,
a large number of bidders.
yeah. Right.
Retail, it's usually a smaller universe.
Smaller pool.
You might have
Yeah.
like five groups bidding on something.
Yeah.
It depends.
Right. And so it's a much, well, not easier necessarily, but it's not nearly as competitive.
Yeah.
So,
We finished second an awful lot, though. I mean, I want to be clear. We
oh,
still not, it's never a slam dunk that you're gonna get a
oh,
deal. But yeah, we generally are, we find interesting opportunities, and not every bidding, like all bidding processes are different, but yeah, it's generally fewer bidders than what you'd see in multi.
well, I'm curious, how many times have you been in second and then the first bails out and you end up with the transaction? I mean,
It's happened a few times.
yeah,
Not as much recently, but it's happened a few times.
yeah. I mean, second's not always bad because then you maybe get to, anyway, you get in at a lower price and maybe a better deal, but who knows? Uh,
Yeah.
anyway, all good. So okay, so I just curious, I assume, and maybe I'm wrong here, that when you're reporting on a particular shopping center and a particular investors in that shopping center, your reporting goes specifically from that shopping center to the investors. It's not
Yeah.
like a big picture. Here's LBX, LBX, and here's all the stuff we're doing. Yeah.
No, I mean, the way that I'm happy to, send you some as a follow-up, but the way that our reporting always reads is we start off, we'll tell people, here's what we're distributing, and here's the property level performance. It's actually structured a lot like an equity research report because that's what I used to write. And then we'll talk about initiatives,
Mm.
right? So at the beginning of the relationship with our investors, well, I shouldn't say that. So at the beginning of a deal, right?
Hmm.
So we have a lot of
Yeah.
repeat investors we've known a long time. But at the
Right.
beginning of a deal, what we do is we send out information to folks and we say, here's what we like about the deal. Here are, our let's say 4 or 5 strategic initiatives for the property,
Mm.
right? So it could be, we're going to lease up a box space, or we're going to sell off an out parcel, whatever the value creation initiatives are going to be. We're going to lay all those out at the beginning. And then when we close the deal, we remind everybody what those initiatives are. We send them an email. We say, congratulations, thanks for placing your faith in us. And as a reminder, here's the various initiatives that we're planning to execute on. And then we report to those, right? So on a quarterly basis, my job when I'm writing reports is always to think about what the investor cares about, right? And so if you put money with us, um, you know, you're sitting there as an investor thinking, okay, well, how's the value creation going? How, I mean, look, like particularly if it's a syndicate, right? A lot of investors, are certainly going to care about what the distribution looks like because it's just, one of the reasons why folks, invest in commercial real estate syndications.
Right.
So, they're going to understand the distribution, but they're going to want to understand things like, how are the distributions looking, and are there risks to the distributions, and, how are you doing with the various initiatives, and what's the timing of those, and, what's the impact of those going to be, right? And then, so we put all that in narrative form. So, you can read a one-page snapshot right on the front of the deal, and it's going to give you a lot of information about how your investment's doing. And then we provide a lot of additional support. So we'll give people a site plan and show how we're how what leases we're signing or what's in progress, or we'll give them very detailed financials with analysis so they can see any variances, and whether those variances are related to us making a mistake on a budget or just something timing related, because there's a lot of timing related variances in retail numbers. And we try to be really, really comprehensive with it. And then in terms of what I do, I mean, I sometimes I joke with people, they ask me what I do. I say I'm, chief bartender, right? I mean, I really, I we have hundreds of investors, right? So, and I try to make it a point to always be available and responsive, and I try to be, helpful. So, I get emails. I mean, I get emails from, and we have investors all over the place. So I get emails from, all different time zones, all hours of the week. Drives my wife a little bit crazy, but it's like we've been building a business, and my job is to make sure that people understand how we're doing for them, right?
Right. So critical factor. So okay, so what is your crystal ball saying about the future?
The future, like, um, I mean,
Well, let's just say for now the future at LBX, and then we can broaden that if you like.
yeah, I mean, certainly from an investment standpoint, we do like the core plus space a lot. I think there's a little bit of a dearth of capital, um, in that space at the moment. So, we've been seeing some interesting deals where the return profile maybe isn't as high as a one-off value add deal, but the risk profile is really attractive, and we always risk adjust our underwriting. So, if you can give me a 14 or 15 with a much lower risk profile, I take that over a very risky 20 any day, right? And
Right.
so, we've been seeing interesting opportunities there. We'll see if we, do anything with it. On the value add deals, I mean, it's a little tricky because, one of the misconceptions that people sometimes have with retail because of some of the narratives around the sector, right? They worry about Amazon or some high profile bankruptcies or other themes, that people are just, increasingly, maybe not just Amazon, but people are increasingly buying online, or malls are dying, or whatever it is, right? Retail, I mean, I guess now there's the office apocalypse, but for a while, retail was the only sector that, had its apocalypse. And so, but it's a misconception because, we tend to we look to buy what we think is the number one or two center in a good market. And so, if we're buying, high quality retail, generally speaking, it's not distressed,
Mm.
right?
Right.
And
Yeah.
and so if it's performing and it's great real estate, right? y- y- You know, it's less of a it's less, I'd say, it's not to say that trends don't impact retail, right? I mean, if you have a consumer slowdown, it's, obviously not great for retailers.
Right.
Um, and if you have a, consumer, speed up, it's going to be better for retailers. But we generally are finding interesting opportunities in good times and bad. And it may be a little bit counterintuitive, actually. It's easier, I'd say, right now to find interesting opportunities than than it was maybe in 2022 when, everything was going up, right? Because when you see deals, they become more complicated maybe, but you can still find really good opportunities and really good value in the current climate. So I don't know. I mean, I would think that on the value add side, we're just going to continue to do what we do. I mean, we've been, sort of, doing anywhere from, let's say, 2 to 5 deals a year for the last several years, excluding COVID, right? We didn't buy anything in 2020 or for the first half of 21. And
Right.
I would think we're going to continue to see opportunities and hopefully they're interesting ones, right?
Well, and retail is hot right now. So, I would think that that in itself, well, it probably creates some overpriced assets, but it also maybe creates some opportunity for buying.
Well, yeah, so retail being hot, if we have, let's say we have, because I'm thinking of a deal where we sold recently. Like, let's say we have a deal and it's got a grocer and it's in a hot market, right?
Yeah.
And it's got a little bit of a value add potential to it. We'd rather sell into that than buy into it,
Ah,
generally speaking, because, we're value guys, so we're not interested in, overpaying for stuff by 25%. And if you look back at the history of this firm, I mean, originally, so LBX started out, the concentration was entirely in the Southeast. You look at all of our early, our initial acquisitions, it was all Southeastern US. And then COVID hit, and all of a sudden, if you remember, I mean, you're up in San Francisco, right?
yeah, yeah.
Okay. So, I'm sure you remember, all of a sudden everybody is, fleeing the blue markets for the red ones, right? And
Right, right,
now, was this 100% the case? I don't know. Was it a big prevailing media narrative? Yeah, definitely a narrative. And
right.
so all of a sudden we started seeing like REITs say, all right, we're going long Sunbelt retail. We're selling all our stuff in those unglamorous markets and we're gonna, pile into Raleigh, Durham and Nashville and
Oh,
Charleston,
wow.
so on and so forth.
All the great
So
mark.
when that happens, kind of means a couple things for us. First off, we don't want to go head to head with a REIT, right?
Mm,
Their cost of capital is cheaper than ours, and they're going to outbid you, right? So we don't want to do that. Secondly, if they're going long something, right? They gotta be short something else. And so we found where, they were, exiting, and not just REITs, but institutions, and mass were exiting markets that we thought, had some interesting opportunities, right?
ah,
So Chicago, for instance, is a really interesting market. Now, Chicago's got some narratives, right? People worry about crime and taxes and government and so on and so forth. But surely there are some good real estate assets in Chicago. There's
Oh yeah.
good real estate assets in, less glamorous markets and bad real estate assets and really glamorous markets, right?
Right,
And
right.
so, we started buying deals that they were selling. And like case in point, like we bought a deal. This is a great example of an LBX special, right? So we bought a deal in not it's in like a middle class enclave, sort of southwestern Chicago. So not, south, like right south of the city,
Right.
where the neighborhoods are rougher. It's more of like a almost like Staten Island demographic, right? So like solid middle class, I don't know, average house of value of
Yeah.
350K, something like that.
Oh
So
wow.
there was a partnership that was being forced to liquidate.
Mm.
The operator, if memory serves, did not want to, exit the property. It was a former enclosed mall that had been converted to an open air shopping center.
Oh wow.
And this center, along with the center across the street, basically that was pretty much all the retail servicing 5 miles of people, right? 5 square miles of
Yeah.
people in a highly dense area. And
Wow.
so, really nice moat type asset, anchored by a Whole Foods that's,
Oh
does well.
yeah.
It's there until I think 2038, right? So it's a stabilized center, maybe a little bit of value add, but it was pretty stabilized. It was like 93, 94% leased.
Yeah.
And, we end up buying it, at a basically there's about a 500 basis point spread between the going in cap rate and our cost of financing, right?
Wow.
And you have a lineup full of credit tenants. And what was really interesting about the deal is it had a tax incentive. And the way the tax
Oh
incentive works is, how retail reimbursements work?
no.
All right. So basically, retail leases are generally, not always, but generally triple net. And
Yeah.
so what
Right.
happens is, you pass through expenses to your tenants.
Right.
So they
Yeah.
might pay, let's say a tenant pays, $15 a foot in rent, and they
Yeah.
might pay like another $10 in triple net, something like that.
Okay. Yeah.
Now, the way that there's different kinds of expenses that you pass through, and some of those are on a lag, right? So for instance, with taxes,
Right.
you get billed for taxes, and then, as the landlord, you pay the taxes, and then pass that on
Yeah.
to, then you bill back the tenants, and
Right.
they pay you back. So
Yeah.
time lag.
Yeah.
Um, this had an incentive which over time will sunset, but basically we are getting reimbursed at a multiple. I forget that, it'll goes up and then it kind of declines, but we're getting repaid, reimbursed at a multiple of what we're paying in taxes. So it ends up turning this stabilized deal into a really attractive cash flow profile.
Wow.
Now, what's interesting about the deal is over time, right? That incentive will, burn off. So it
Yeah.
kind of goes up and up and up and then peaks and then starts to gradually decline. So you have an arc, right, in terms of, how much revenue
Your
you're going to
income.
generate from
Yeah.
it.
Right.
So when you plug that into, say, like a REIT model, right, doesn't really work because they need something that's going to have gradual FFO going
Uh,
up, right? Now on the back end of that incentive will be gone. So, they could be, more likely buyer on the back end, but the large institutions were not really in the mix for the acquisition process there. It was us and I don't know, like maybe like three or four other private groups that bid on the asset. And we
yeah.
end up getting this stabilized deal, which is cash flowing in the teens, and it's really high quality asset, and it's just really really. I mean, it's a sort of deal where if we could do like one or two of those a year, it'd be amazing. But they're a little bit like unicorns. You can't just find them. But that's an example of the sort of deal we would do. And basically the world wasn't looking at it because people were down on Chicago because they're really up on Nashville and
Uh,
Texas. Right. And it's
right.
not to say that there's not great deals in Nashville or other Sunbelt markets. There are, and we own some, but we've over the last few years we've been able to expand our footprint into other markets by um, at the end of the day, we take each deal as it comes, and we dig in, and we evaluate deals, through our own risk return parameters, and we've been able to maybe see some things that other groups don't.
So I assume most of your investors are reinvesting. They aren't cashing out.
Yeah, I mean, we don't tend to, like, we don't do ticks. So when we sell, generally, like, if we're syndicating something, we're probably not going to do a 1031 because our vehicle is typically an LLC. Now, if let's say we have a family office in a deal, it's one investor, you can be a lot more nimble that way on the on a sale in terms of redeploying. But we have a very high repeat investor rate. So investors put money with us, they have a good experience. Then we have another deal and they put money with us. And, we have some investors that have, God, I don't know. I mean, we have some guys who have, well north of 10 positions with us. So,
Wow.
Out of 20 deals. So we have a very high repeat investor rate.
Yeah. Yeah. So it sounds like most of them are cashing out and not exchanging into future properties.
Yeah, we haven't done, we haven't set up a 1031 mechanism.
Yeah. Yeah. So that works fine for a family office and so forth, and they're fine with getting the cashing out and going forward.
Yeah.
Yeah. Well, okay. This is very fascinating. I think we could probably talk for another couple days about this whole uh, area, but I think I want to reconvene maybe in 6 months and see if the market has changed or what's happening. I'd love to talk to you further down the road here. So let's call it for now, and we'll keep in touch and see where we go from here.
Perfect. Well, I hope this was helpful.
Oh, very helpful. Very good. I think we'll definitely get some folks listening, no doubt about it.
Great. Perfect. Do you need anything else from me, or they've got my info, or how does?
Just hold on here for a second. Where can people find you?
Yeah. So easiest way is just to email me. Heath, so Heath at LBXinvestments.com. They could also go to our website, LBXinvestments.com, and there's an investors tab you can click on, and you just put your information in and it'll come right to me, and then I'll give you a call.
Perfect. All right. Well, let's keep in touch. Hold on.
Definitely. Thanks so much, Bruce.
That's a wrap on today's journey through the SF commercial real estate scene. Ready to share your story? Visit sfcommercialconversations.com/guest. Your insights could lead the next conversation.